Hi everybody, welcome back to the channel. Today we're talking about the iShares Silver Trust. As you can see, this is trading at $27.70. What that means is this right here gives us the opportunity, if we look at some of the trends of silver, you can see that we have been in this trend upwards over the last several months, specifically since March. We were trading at $20 and now we're trading at $27. One thing I want to point out with, first of all, if you're new to options trading, we're going to get into some of the specifics of options trading. I do offer consulting and I do offer video coaching where I can basically go over all these concepts with you for 1-hour sessions. If you're interested, I'll leave a link below. With that being said, this is what I call the beta of the stock. Now it's 0.73. 0.73 means it's less volatile than the S&P 500. So if we take the S&P 500 as a benchmark index, a 0.73 beta means that this ETF overall is going to be less volatile than the S&P 500. I'm going to get into that more in this video and why that's important. But first of all, let's go ahead and take another look at the technicals here. You can see it kind of bouncing around, so it's kind of hard to say, well, it's going to go down to 27 or going to go to 29. But if we really wanted to play this, we could. And what we could do is enter into a trade, specifically a cash secured put trade. And if we're looking at a cash secured put trade, what we have to do is first probably go over to Fidelity. And I have all these numbers set up. We're going to go over those as well. But I'm going to go ahead and log into my Fidelity and just do a pretend trade here. Going to go on over to options trading on my Roth IRA, and let's go ahead and select a symbol. We're going to do IWM. IWM is the Russell 2000 ETF, iShares Russell Small Cap ETF. Now, I made a video on this one. I want to go ahead and mention that real quick, but the ETF we're doing is SLV. Check out my recent video on IWM, though. This is kind of similar to this one in terms of the strategy we're doing, but it's just on a different asset. And so when it comes to selling cash secured puts on the iShares Silver Trust, we have, let's say, an option that expires on December 27th, 2024. If we look at the iShares Silver Trust right now, it's trading at $27.72. What this means is we could say, let's take a look at the $27 strike, and let's go ahead and say that we have roughly, a good amount of money to throw at this. Okay, let's just say that we have been doing well in the stock market and we have built up a portfolio of $150,000. We're just going to assume for this example, I know it sounds a little bit extreme, but I want to kind of just, bear with me because this gives you an idea of what's possible when you get to the larger numbers in your portfolio long term and how you can actually turn this into regular cash flow, because that's what we talk about on this channel. So if we're looking at $27.72 as the current market price, the important thing to remember is we're going to be selling puts at 27, which means we need to have the collateral to go ahead and enter this trade. And what we need to do is calculate how much that would cost. Well, if we're going to buy, let's say, 6,000 shares, let's call it 6,000 shares at $27, we're going to need 162,000. So let's try to shoot for, let's say, 5,800 shares. And we're going to go ahead and try to get down to 150. In fact, we'll go down to 5,700 shares at 27, 5,600 shares at 27. So 150,000 is what we're going to be investing here. $150,000 into SLV. That's the capital requirement, or just a little bit above that. As you can see, 5,600 times 151,000 is going to be our trade at $27 per share. So with that being said, we can go back to our trade here and we can say, well, that means we're going to have to divide 5,600 by 100 because we have to determine how many shares or how many contracts can we buy, because each options contract is going to be 100 shares. What this means is we need to go back and figure out, well, in this case, we can buy 56 contracts. And if we take, let's say, the $27 premium, you're looking at $2,763 in cash flow that's going to hit your account right away when you do this trade. So if we enter this trade for 5,600 shares, we're putting this on the line, agreeing to buy 5,600 shares at a strike price of $27 on SLV. And the expiration is December 27th, or roughly 1 month out. So what this means is we're approaching almost $100 per day. If we assume, 30 days in a month divided by 27.63, you can do the math on that and figure out how much you're making per day. But if you really wanted to get to like a level, let's say, where you want to consistently try to make $100 per day, we're going to have to take a little bit more risk on the delta. And what that means is if we take a look at 27.50, this one is going to have a higher delta, or basically higher chance of it going in the money, higher chance of the option working out not in your favor as the seller, because you're trying to make cash flow and you're hoping the buyer of the option goes away. You're hoping the buyer of the option is never heard from again. You basically want to make the cash flow from selling the put option, and that's it. So the hope is that it stays above 27.50 within the next month. Now, if it doesn't, that's only 22 cents away. 27.72 minus 27.50 is basically 22 cents away, right? So can that happen? Can it go down under 27.50? Absolutely. That's actually, I'm not going to lie, that's like definitely something that could reasonably happen. And that's very close to the expiration. So the more capital you have is what I'm trying to say, the better this can work in terms of cash flow and also retirement, because you could perhaps do like a $25 or $26 strike if you had the money, and you could make the same amount of money, but with just a larger amount you're putting up. And so in this case, if we look at a 27.50 strike, which is just below, you're still buying at a discount out of the money, but 22 cents, this is actually going to be trading for about $4,000 almost, $3,900, which means we're hitting over $100 in a single month or per day for that month. $3,900 is the amount you're receiving. And when you're receiving this, this includes the commissions built in. So what that means is you're collecting $39.60, and you have a commission of $36.40, and this is based upon the current bid pricing of the option, or what price the option is trading at right now, 0.71 to 0.72. Once again, we're selling to open 56 contracts of the December 27th, 2024 put option at a strike price of $27.50. What this means is we're basically agreeing to buy 5,600 shares at $27.50, which, if we do the math on the collateral requirement, just to confirm, 5,700 shares at $27.50. I'm sorry, 5,600, wasn't it? I probably just messed that up. Was it 5,600 times $27.50 is going to be 154,000 in this case. So roughly 154,000 is going to be the collateral requirement. But you can kind of see how this could work for somebody who's in retirement looking for cash flow, if they're actually doing this against ETFs like SLV, GLD, and stuff like that. And also, if they're willing to do this just because they love the ETFs and they want to get long silver and long gold and actually participate in some of the movements and the price action, because you can make money on the upside as well by doing the wheel strategy against this. And remember, you're still buying the shares at a discount. So you're still getting, a 22 cent discount at the current market price. And if you look at it, when you're putting in this trade, that's about $3,900 at a bid price of $71 per contract times 56 contracts, basically $71 per contract times 56. It gets you the total amount, the dollar amount of your premium, and that's yours to keep no matter what. Now, as I mentioned in my last video on IWM, which I made earlier, the max loss does not matter. We don't want to really think about this max loss because the iShares Silver Trust is not going to zero tomorrow. And, I did mention I was going to talk about the beta and how this relates to the delta, right? So as we talk about the ability of something to move in the money, if we talk about the iShares Silver Trust and we think, well, could it go down below $25 per share in the next month? What's the chance of that happening? What we can actually do is look at the beta relative to the volatility of the market and help us determine, is that a reasonable move relative to, the put option we're selling, basically, the strike price and everything. So we kind of look at that, and then we look at the delta, and that's the chance of, basically going in the money. So a lot of people will tell you, 0.2 and under delta is going to be good. That means basically an 80% chance of it expiring worthless, and that means in this case that you would be able to make money from the option and do nothing, and the buyer of the option would lose in this case. You, as the seller of the put option, you would benefit. Now, worst case, if it does go below $27.50 or whatever the strike price you choose is, then upon the expiration day, let's say you have to deliver, you basically have to buy the shares at the strike price, and a put option becomes, now you can start selling call options. And so now you can turn around and start making money from the call premiums. And that's one of the main benefits of the wheel strategy, because you can basically switch it around and continue to do this nonstop. So with that being said, thank you so much for tuning into this video, as always. And hope you all have a fantastic Thanksgiving if we don't talk again. I know I just made a video early on IWM. Once again, check that video out if you're interested. And we will see you guys in the next one. Take care.